Do you ever look around and wonder why the average American struggles to build wealth while a select few seem to effortlessly pull ahead in their financial journey? The truth is, the gap between the average earner and the truly wealthy often comes down to a few distinct habits, mindset shifts, and financial strategies that the majority simply overlook. In this video, we are going to dive into the shocking money stats that reveal how the top earners and savvy investors operate, and we will uncover 5 undeniable signs that you are far above average when it comes to managing your personal finances. Whether you are just starting out with your first savings account or looking to optimize a multi-figure investment portfolio, understanding these financial indicators will give you a clear roadmap to accelerate your path to true wealth and financial freedom. Part 1. Maintaining a high savings rate that exceeds the national average. When you look at the macroeconomic data in the United States, the personal saving rate often hovers in the low single digits, which means the vast majority of people are spending nearly everything they earn and failing to build a meaningful financial buffer. To truly separate yourself from the average earner, you need to aim for a savings rate of at least 20% of your gross income. This is not about the exact dollar amount you put aside each month, but rather the proportion of your earnings that you retain and funnel toward your future financial goals. By maintaining such a high savings rate, you are effectively reducing the amount of capital that disappears into consumer spending, which alters your financial trajectory completely. The mechanics behind achieving this level of saving rely on a combination of intentional budgeting and systemic automation that removes human error from the equation. The most successful individuals do not wait to see what is left over at the end of the month to put into savings. Instead, they treat their own savings account as an essential monthly bill that must be paid first. Setting up automatic transfers that move funds from your primary checking account directly to an investment or high-yield savings vehicle the very day your paycheck arrives prevents the temptation to spend money on non-essential items. This method of paying yourself first forces a lifestyle adjustment that keeps your daily expenses aligned with a lower percentage of your income, allowing the gap between your earnings and your spending to widen over time. To take this a step further, the psychological barrier of lifestyle creep must be actively managed whenever your income increases. As you receive raises or find better paying opportunities, it is incredibly common to upgrade your living situation, your vehicle, and your daily habits, which keeps your savings rate stagnant despite a higher income. Above-average individuals intentionally allocate a major percentage of any new raise directly into their savings or investment accounts before they ever see that money in their day-to-day spending account. This strategy ensures that your wealth grows exponentially over time, shielding you from economic instability and giving you the dry powder necessary to capitalize on market corrections or new business opportunities whenever they arise. Part 2. Growing your net worth faster than your earned income. When you rely solely on your active income or salary to build wealth, you are hitting a mathematical ceiling on your potential because your earning capacity is tied directly to the number of hours you can work. To break through this limitation and join the ranks of those who are far above average, your net worth must grow at a faster rate than your earned income, which means your investments and assets must begin to do the heavy lifting. This shift occurs when the passive growth of your investments, combined with capital appreciation and dividend yields, exceeds the money you bring in from your primary job. Achieving this requires transforming your earned income into productive assets, rather than letting it sit in low-yield savings accounts or depreciating vehicles. The mechanics of accelerating net worth involve understanding the power of compounding returns and asset valuation. For intermediate and advanced individuals, this means looking beyond simple savings and actively seeking out assets that grow in value, such as index funds, real estate properties, or business equities that generate cash flow. When an asset appreciates in value, or when you reinvest dividends and interest, that additional capital starts generating its own returns, creating a snowball effect. This creates a divergence where your net worth chart steepens exponentially compared to the linear line of your earned income, allowing you to build substantial wealth even if your salary remains relatively stable. To put this into practice, you need to actively track your net worth at the end of every quarter and calculate the ratio between your asset growth and your salary. If your assets are not growing faster than your paycheck, it indicates that your capital is either sitting idle in cash or allocated to underperforming assets that do not beat inflation. You can start by reviewing your portfolio and shifting excess liquidity above your emergency fund into index funds or other income-producing vehicles that have a historical track record of outperforming standard wage growth. This deliberate reallocation ensures that every dollar earned becomes a worker that generates more money, effectively decoupling your financial growth from your physical labor. Part 3. Leveraging debt strategically to build wealth. When it comes to building wealth, the average person views all debt as a negative burden to be avoided at all costs, while those who are far above average understand that debt can be a powerful tool when used strategically. The key distinction lies in understanding the difference between bad debt and good debt, where bad debt is used to finance depreciating consumer goods and good debt is used to acquire assets that generate income or appreciate over time. For beginners, this means eliminating high-interest credit card balances and focusing solely on borrowing for assets that put money back into your pocket. By separating the two, you ensure that any leverage you take on serves as an engine for growth rather than a financial anchor. For intermediate and advanced investors, leveraging debt means utilizing other people's money to amplify your purchasing power and generate a higher return on equity. In real estate investing or business expansion, using a mortgage or a low-interest business loan allows you to control a valuable asset with only a fraction of the total cost out of your own pocket. If the asset produces cash flow that exceeds the monthly debt payments and the property appreciates in value, you are leveraging the bank's capital to build your own net worth. This strategy allows you to scale your investments much faster than if you had to save up the entire purchase price in cash, effectively speeding up your timeline to financial independence. However, using debt as a wealth-building tool requires strict risk management and a thorough understanding of cash flow dynamics to avoid over-leveraging during economic downturns. To apply this in your own financial life, you must ensure that your debt-to-income ratio remains low and that the underlying asset produces enough income to cover the debt service even if market conditions worsen. Before taking on any new debt, calculate the return on investment and compare it to the interest rate of the loan to ensure a positive spread. By maintaining a conservative approach to leverage and keeping emergency cash reserves on hand, you can confidently use debt to accelerate your wealth accumulation while minimizing potential downsides. Part 4. Practicing consistent and unemotional investing. When market volatility strikes, the average investor often falls victim to fear and panic, frequently selling off their holdings at the bottom or chasing speculative trends at the peak. Being far above average means recognizing that market fluctuations are a normal part of building wealth and that emotional reactions usually destroy portfolio value over time. You must train yourself to view market downturns not as a financial catastrophe, but as an opportunity to buy high-quality assets at a discount. By detaching your emotions from your portfolio, you allow logic and long-term strategy to drive your decisions, ensuring that you remain invested during the most crucial periods of market recovery and growth. The most effective mechanism for maintaining consistency without emotional interference is implementing a dollar-cost averaging strategy through automated contributions. By investing a fixed dollar amount into broad market index funds or blue-chip stocks at regular intervals, such as every week or every month, you remove the guesswork of trying to time the market When prices are high, your fixed contribution buys fewer shares, but when the market dips, your money buys more shares, effectively lowering your average cost per share over the long run. This mechanical approach insulates your portfolio from the psychological noise generated by financial media, keeping you steadily on track regardless of short-term economic news or temporary market corrections. To apply this disciplined approach in your own financial life, you should establish a clear investment policy statement that outlines your long-term goals, asset allocation, and rules for buying or selling. Stop checking your investment balances on a daily basis, as this only triggers the urge to tinker with your portfolio based on temporary fluctuations. Instead, limit your portfolio reviews to a quarterly or semi-annual schedule to rebalance your assets and track your progress toward your financial independence number. By treating your investing like a mechanical system that operates in the background of your life, you eliminate the emotional friction that prevents the vast majority of people from achieving above-average wealth accumulation. Part 5. Prioritizing income-producing assets over consumer liabilities. The fundamental difference between those who struggle financially and those who build generational wealth lies in how they allocate their surplus capital. While the average consumer tends to spend their disposable income on luxury goods, new vehicles, or depreciating items that take money out of their pockets, those who are far above average prioritize income-producing assets. These are assets like dividend-paying stocks, real estate, or business ventures that continuously put money back into your pocket. By shifting your mindset to view every dollar as a worker, you stop trading your time for temporary status symbols and instead build a system of wealth generation that operates continuously. The mechanics behind this shift require analyzing your cash flow and making intentional choices about what you purchase with your hard-earned money. When you receive your income, the priority should be to purchase assets that appreciate in value or generate consistent cash flow, allowing your money to do the heavy lifting. For instance, putting money into a diversified index fund or a rental property allows you to capture market growth and rental income, which can then be reinvested. Over time, the cash flow generated by these assets begins to cover your living expenses, effectively creating a safety net and moving you closer to financial independence. To put this into practice, you need to conduct an audit of your current spending and assets, identifying liabilities that drain your monthly cash flow. Make a conscious decision to delay the gratification of purchasing consumer goods until your asset portfolio is large enough to fund those luxuries through its own passive income. Whenever you are about to make a discretionary purchase, ask yourself whether the item will generate wealth or just consume your resources. By redirecting funds away from liabilities and toward income-producing assets, you transform your financial life and secure a much stronger, self-sustaining financial future. To wrap things up, separating yourself from the average earner and building true wealth does not happen by accident. It requires conscious choices, a disciplined mindset, and the willingness to let your money work for you rather than just working for your money. By maintaining a high savings rate, growing your net worth faster than your earned income, leveraging debt strategically, investing without emotion, and prioritizing income-producing assets, you are setting the foundation for long-term financial freedom. If you found this video valuable and want to continue learning how to grow your wealth, make sure to subscribe to the channel so you never miss our upcoming videos on personal finance and investing. Leave a comment down below with the phrase "My money works for me" to let me know you are committed to taking action, and I will see you in the next video.